Welcome to TheoTrade and the Theo evening video for June 20th, 2016. S&Ps explode out of the gate today all the way up to 2092 and have faded throughout the course of the trading session, which literally just ended a few seconds ago. But the S&Ps given up over half their gains in the day. Looks like the closing bell, here we are at 2074. So what is some of the action that, number one, drove the markets a little bit higher? I don't like to play so much of hindsight here, but there's some important lessons to be learned from not only today's market, but what is going to occur the rest of this week. Number one, what actually sparked the rally over here was the fact that the British exit, it's off the table. What do you mean it's off the table? Well, the probability of the British exit has dropped now to about a 26% chance, depending upon which odds you're looking at. Looks like now about a 26% chance. So the market immediately anticipates this is going to be wonderful. Or is it? Or some of the selling that we saw, okay, in markets over the last, 2 weeks of trade here, and that's the selling was not extreme, but did some of the selling really coincide with other risks that are prevalent inside of the marketplace? Now, I believe the latter of the two, and again, the S&Ps, here we are, and even the after hours continue to slip. One of the things I want to point out, and I'm going to use the TLT to do this, is well before really any really considerable discussion of the British exit happening, the bonds were already trading. Okay, to say an upward momentum would be an understatement. The bonds have been in an extremely defensive posture, and we can actually go all the way back to, again, the beginning of June. Here we go, 20 plus days back, and the bonds were already exploding. Now, it was only really about a week ago that we started, the British exit, it could happen over here. Yet the bonds, again, were pricing in just more risk to the marketplace well prior to that. So the bonds, they sold off a bit today, but nothing like a catastrophic move to the downside like you would expect if all of the British, again, risk had abated from the marketplace. My take on this today, the risk isn't about the British marketplace. The risk is much more about the global economy right now. And bottom line is, yeah, sure, some of the risk actually priced into the bonds definitely abated today, but not that much. I think the S&Ps also reflected as they faded hard. Fading means, whatever the move is, fade the move. Well, the move today was vastly to the upside, and as the day progressed over here, traders were coming in and fading this. And I say fade the move, well, this is a fairly radical move to the downside and some pretty monstrous volume here coming into the close. Now, think about this for a second. So risk, is it still prevalent in the marketplace? Well, we go down to the volatility futures. If all the risk is off the table, the British exit, then number one, again, I don't think it's just about the British exit, but you realize the volatility futures, they spiked. Yeah, they backed off a little bit over here. They've been backing off for a couple of days. Nevertheless, they're still heavily elevated from where they were just 2 weeks ago, all the way down here in the 14 level. So you really better consider, and again, here we are 4 minutes after hours, and those S&Ps have slipped another 3-4 points over here, and the volatility futures are rallying back up. More importantly with this, take a look at the volatility futures 30 days out. They're at 1872, 58 days out, they're at 1942. Again, risk to a degree came out of the market, but not nearly as much as you would have expected. One other piece of evidence that I want to look at inside of today's trade over here, I'm watching this all day long. The volatility today inside of the XLF is still upwards of 29%. That does not make sense. Now, yes, yesterday the volatility was, albeit minimally higher. The volatility has not come out of the financials. That's the point I want to make over here. And the volatility, again, not coming out of the financials, this week, all it's telling me is we are going to see some fairly wild swings throughout the course of this week. And again, go back over to the SPX, and forget about trying to discern what you think the S&Ps are going to do right now. Okay, let me tell you something in a marketplace like we're in right now. Okay, direction is futile. Trying to pick direction right now, it's futility at its best. You get a fear for volatility, okay? And I think you're going to get a better feel for the marketplace. Long duration, okay? Over the long duration, we're talking about months over here. I am absolutely, and I say this without an equivocation, bearish in the marketplace. The risks are just pent up. The bonds are trading what I term Armageddon levels out there. That means really, really high. But I still see, again, abundant risks displayed everywhere in the marketplace. Short duration, the next week or two, they're not giving us too many clues as to what is being anticipated in order flow. All I can tell you, though, is this, and again, this I say without unequivocation. When you look at the volatility from the 2-day options to the 4-day options, you can see they're still pricing in a lot of risk to this British exit here. And again, we're at 23% implied volatility with a $43 expected move. That's over the next 4 days. Okay, and what does that really break down to? If you look, that's what they call probability of expiring. So there's, in the terms of the probability of expiring, and I'll kind of frame this out for you here, because this is what matters right now in the next couple of days, so you don't get ripped apart in your positions. The market is anticipating a plus or minus, okay, let's just call it, we'll round it up to a $44 move, plus or minus, and that's going to occur about 68% of the time. But that's also what they call a prob of expiring. So that means in the next 4 days, we're likely to expire inside of that $44 range. It means the S&Ps are going to go about $44 higher, $44 lower, and they have about a 68% chance of staying in that $44 range, okay, in that period of time. However, there's also what we call a prob of touch. What's the probability of touch? It's double that, which means, lovingly, we could see almost a $90 move in the S&Ps. Okay? It's some of the highest moves that we've seen in quite some time. You know, if you think of like a $90 move inside of the S&Ps over there, you know, by the end of this conversation, you're going to have your helmet on hiding underneath your desk. You're like, we're going in, man. Well, get this. That's based on the 4 days and a 23% implied vol. When you look at the XLF is still pricing in almost a 29% volatility, meaning the financials are still assuming that this is going to be the riskiest sector. It's risky. I'm dangerous. That's what the financials are screaming right now. Okay. What you need to consider over the next couple of days, it's not about, is Google going to go up? Is Google going to go down? Okay. First of all, Google again is facing, almost the 700 level. What's more important right now is what's the market going to do? All right. The risk levels abated very, very slightly today. However, you look at things like the VIX, you look at things like the volatility futures, they barely backed off. What happened to this whole British exit vote is you might now see the risk isn't about the British exit. The risk has been prevalent prior to that. Last but definitely not least over here, the VVIX, something I've brought up a lot in the last couple of weeks. The VVIX still wildly elevated and rallies into today's close, getting above a very key threshold level of 110. Again, I want to display this, and I'm going to display it now on a 3-year daily. Okay, and for those of you that are not necessarily, if you're listening to this and you're like, I don't even know what a VVIX is, but I'm very excited about it. The VVIX, it's the volatility of the volatility index. It says, how risky is volatility right now? And the answer is extremely risky. And if you look back over the last 3 years, okay, you can point out on basically a few fingers the number of times that we have sustained over a 110 VVIX. We're there right now, but we're like at that point. We're like 112. We're at a very key inflection point for volatility. All right. One thing you need to be reminded of, don't sit and wait for this news to come out in the British exit vote. Again, I don't believe that that's what the risk is about. Okay, part of the risk of this marketplace is that people have been positioning in and around the British exit for weeks, some of them for months, and the unwinding, well, the British vote, it's off the table. The unwinding of those trades could wreak havoc. Many trading firms right now, retail or otherwise, are actually changing their margin requirements on an intraday basis, meaning that they're not going to extend you nearly as much margin. It's a little bit of a warning sign. The risk managers see the risk on the table. By the way, just to bring this up, this is a 3-year weekly over here. Why not? We'll just go to a 5-year weekly. Again, you can count pretty much on 2 hands the number of times we've actually seen the VVIX above the 110, sustainable above the 110. You zoom in once again, in the nearest term, the VVIX is understandably, why I'm looking at risk over here. The VVIX closes above the 112 level, and right into today's close, and you're about to see a 1-minute chart exploded higher once again. So risk. Okay, I don't care what anybody says. It is still on the table over there. And as such, you should plan accordingly. Throughout the course of today's trading session, we did put on a bullish trade inside of the GLD. For those of you that are TheoTrade members, take a look in the TheoTrade tracker. Again, we now have a bullish position on the GLD. Thanks, everybody, for joining us here at TheoTrade. Be back on tomorrow. Have a good evening. Bye-bye.